The US government may not be interested in making sure that it can fund itself, but it is certainly interested in funding Intel. And it's not the only group that's looking to back Intel, which is potentially setting Intel up for a really interesting Apple, Microsoft-like moment. Tune in for that on Altimetry Authority today, and also a special 3-minute drill on Tesla at the end.
Let's talk earnings and favorite pastime.
So let me just say,
stupidity
why
of Wall Street. It's 2.5x.
Because their compensation goes up.
Wall Street's wrong again.
The federal government doesn't seem to be interested in funding itself, but there has been one specific area that the federal government has been very interested in spending money in the last month and change, and that is giving money to Intel. You may have seen the news, obviously, in late August. It was a big to-do, right? The Trump administration basically said, hey, we are going to invest in Intel, and we are going to give money because we basically want to declare that we need a national champion in terms of being able to build chips in the U.S., which was really, really important because of what it said for Intel in terms of, where we look at Intel going forward. And, it wasn't just the Trump administration. Of course, then Nvidia came behind and basically said, hey, we're going to put $5 billion into Intel, and we're going to start to talk to Intel about leveraging our relationships with it to have it start to build chips for us to be able to help us with build AI infrastructure, right? Really, and if you think about it from NVIDIA's perspective, it makes sense because it's kind of saying, hey, we need to basically potentially diversify our need on Taiwan Semiconductor and everything else, along with, obviously wanting to stay in this administration's good grace. And then later on in September, of course, rumors started to swirl, which nothing's been confirmed yet, but that, Intel was potentially even seeing Apple invest in Intel and potentially rely on Intel to make some of its chips, its ARM-based chips that it makes to power everything from the iPhone and the iPad to AirPods like I have on, Apple Watch, and, MacBooks and everything else. And, the fact that Apple came into this actually made us, reminded us of something when we were looking and thinking about Intel. It reminded us of really Apple's moment of desperation when somebody swooped in and saved it, which was really all the way back, if you remember, when Bill Gates and Microsoft stepped in when Apple was basically bordering on bankruptcy. And as it was bordering on bankruptcy, basically said, hey, look, we are going to invest in Apple. And we're going to invest in Apple because of the fact that we think it's an important part of the ecosystem. Now, in reality, right, the reason why Microsoft supported Apple and basically swooped in was two reasons. Reason one was because the fact that Microsoft recognized that it was not in a great place with antitrust in the late 1990s, early 2000s. And so they understood that if we kept Apple alive as a stalking horse, if you will, in the PC world, that benefited Microsoft because of the fact that it basically said, hey, there's an alternative to PCs out there. We don't own the whole entire market, federal government. You can't be mad at us, as the federal government was coming after them for antitrust. And there was a second reason, too, which was part of the deal, was that Internet Explorer had to be basically the primary default browser for any Apple computer once they made this deal, which Microsoft at the time understood that the internet browser was the portal to give access to so much of why people were using computers, so that mattered to them. But sure, Microsoft had other reasons for doing it, but basically they saved Apple and set up Apple for really what ended up being the opportunity for Steve Jobs to give the runway to then create the iPod and iPad, the iPhone, and everything that transformed Apple into one of the most valuable companies in the world today. But it was interesting because if you think about what NVIDIA is doing, right, of course, NVIDIA doesn't view Apple as a competitor. It doesn't view Intel as a competitor like Microsoft did for Apple in terms of keeping a stalking horse. For them, it's probably actually a smart move because of the fact that they do think, hey, this could give us an opportunity to diversify our real just need in from a vendor perspective to have Taiwan Semiconductor and whatever could happen there. So it makes a lot of sense, but it's really interesting to us because it felt like, oh, this is really Intel's Apple moment, where what's happening is with all these people stepping in, because Intel, as we're about to get into, was priced for bankruptcy. And really, these things help take that off. And if you look, it makes sense why Intel was priced for bankruptcy, because if we look at a uniform accounting perspective, it jumps out why, right? So let's jump in and let's look at Intel in terms of what we can see from this business from a performance perspective, and why Intel was down in the dump so much, and why, even after these moves, there might be still some more juice for investors. And so if you look, Intel right here, what you can see is this is the as reported return on assets for Intel. What it shows you is Intel on an as reported basis, just purely what comes off of GAAP numbers, return on assets were around 10% or so in 2020 and 2021. That's around corporate average in the US, which is around 12%. Not bad. And by the way, for the last 15, 20 years, that's what Intel looked like. But in 22 and 23 and 24, it shows you that profitability dropped hard. As really prioritization came in terms of GPUs versus CPUs as we started to understand the boom for AI and what that meant for the data center business, and how data centers really, that had always been for the last decade and change, CPUs and GPUs, really just focused full bore on GPUs. And then also on top of that, lagging in terms of the consumer ecosystem for PCs and the struggles they've had there. Well, if we look at uniform accounting, and what uniform accounting shows is it's been even worse than as reported metrics reflect. Intel was a little more profitable over the last 20 years than as reported metrics reflect, but over the last 2 years, 23 and 24, it's not that Intel has been floating around zero profitability. It's that Intel has actually been hemorrhaging money, losing 5% a year the last 2 years. And that's really important, because what that paints is, if we were to look at this company from a credit perspective, because of that, this company that still is a $100 billion market cap company today, was basically effectively still in a phenomenon, though, where it was going to have issues in terms of having to cut investment and everything else because of these cash flows. And for what it's worth, right, this is what the company had done historically. These two light blue bars are what Wall Street analysts are forecasting Intel to do for the next 2 years, right? When we take Wall Street analyst estimates, right, we don't pay attention to Wall Street analyst target prices because they are a garbage in, garbage out phenomenon. But we do pay attention to their ability to be able to forecast out the next 12 to 18 months of earnings. And what it shows you is they're telling you that Intel is still going to struggle for the next 2 years. And so, right, it made sense when Intel was really down in the dumps in terms of its stock price, because there were a lot of issues. And, one of the ways that we look at a company like Intel, when a company is distressed like this, is we look at it in terms of its price to book assets is another way to look at this when we talk about what we call embedded expectations. And so what this is here is what the market, these white bars are what the market is pricing Intel to do going forward. And so even after the Nvidia investment, right, which caused the stock to surge, right, jumping over 20% in terms of how much it jumped, and obviously the investment from the U.S. government and any rumors about Apple. Right now, the market is only pricing Intel to get to about a 3% return on asset going forward. Now, for context, what does that mean? I mentioned the words price to book before. So price to book is in terms of this idea of what are the value of the assets that Intel has put in the ground, and what is the value the market is paying for those assets. Anytime that a company's price to book really trades significantly below 1 times, that tells you the market is basically pricing this company below 0.8 times, which is a 20% discount to book value. You really only see that when the market is expecting the company to potentially go bankrupt. Before the combination of the US government and the Nvidia announcement, Intel was trading at close to a 0.6 times price to book. That's a 40% discount to book asset values. Effectively, the market was saying Intel is seriously doomed and possibly could go bankrupt. The Nvidia and the US government actions only got Intel back to a 0.8 times price to book, right? Which is the market basically saying that Intel is never going to get a return on assets above 3 to 4%. That's significant because effectively what we've done between Nvidia and the US government backstopping Intel, we've taken the risk of bankruptcy and the risk that this company is just going to vanish really off the table. Now there's a question of whether or not Intel can execute. But we know when Intel can execute, this is a company that has a return on assets that can get up to 10%. When we look at a company like Taiwan Semiconductor, who is basically a fab, which is a part of why everybody's supporting Intel, that Intel could be the U.S. national champion for fabs, just like basically the U.S. response to Taiwan Semiconductor. It could see return on assets get up there, and the market right now is only pricing in return on assets at 3 to 4% and a sub 0.8 times price to book. And that's what's so interesting to us, because when we look at Wall Street analysts, and this is a classic example of Wall Street getting a company wrong. Wall Street's getting Intel wrong because the fact that you can look at those blue dots Those blue dots are what Wall Street's target prices are for Intel. And the vast majority of Wall Street is still saying that Intel is worth $20 a share, like it was priced for bankruptcy, not recognizing that if Intel does just not go bankrupt and sees return on assets just basically float to cost of capital levels, because the fact that it has support from the U.S. government, people who understand that it's going to that's going to actually, basically everybody wants to work with them because you want to keep the administration happy. People like Nvidia want to diversify their supplier, their vendor group. All that alone could not mean that Intel gets back up to 10% return on asset, right? Betting on companies that are national champions to have all-time high return on assets, not a good bet. But betting on those companies not to go bankrupt, a phenomenal bet that even if we just see this company get to a price to book, a 1x price to book, you're seeing a significant upside from current valuations. And so it looks like this is a really interesting one because, right, I mean, this really is the potential for Intel to be set up for its Apple moment, much like what happened for Apple in the 2000s before we get to the iPhone, obviously. And so pay attention to this one. Really, really exciting company. Really quick though, before we wrap up this episode of Altimetry Authority, we did get a request from one of our viewers recently who asked us to do what we call our 3-minute drill on another company that's a big company in the news constantly, which is Tesla. And so I'm just going to quickly take you through our 3-minute drill on Tesla also, by the way. And just for everybody, if you're interested in seeing our 3-minute drill on another company on a future Altimetry Authority episode, drop that request into the comment section below this video. We pay attention and we're watching, and we will do a 3-minute drill just like I'm about to do for Tesla right now for any company that you all are asking for. So stay tuned for future episodes also. We'll always do it towards the tail end of an episode. And so if we look at Tesla, right? Tesla, very different situation than Intel right now. Intel, the market was worried whether or not Intel was sitting on death's door now. Tesla just broke $1 trillion in terms of market cap. So if you look at Tesla right here, as we always talk about, here is the uniform return on asset for Tesla for the last 5 years. So you can see Tesla in 21 and 22, first mover advantage for EVs, just getting to scale, saw return on asset explode higher, getting up to 30% return on assets. But then what happened in 23 and 24 was two big things. One, of course, with higher interest rates, people were struggling more to finance car purchases, and the U.S. and global consumer was under pressure, so we saw weakening demand. And also, we saw a surge of everybody catching up to Tesla in the EV space. Obviously, BYD now makes more EVs than Tesla. You saw everybody from Ford to GM to Daimler Chrysler to Daimler to BMW pushing out EVs. And so, right, Tesla lost its first mover advantage. So return on assets came back into around 10% levels. By the way, for context, corporate average for cars is around 6% because it's a highly competitive industry. Well, for the next 2 years, Wall Street's forecast for Tesla is for return on assets to sit around 6 to 10% levels. Now, here's what the market at a $1 trillion market cap for Tesla is pricing Tesla to do. The market is pricing in Tesla to get return on assets to 75%. Now, you're going to assume I'm going to say this is crazy. There's no way that Tesla could get to these valuations. And if I really thought that's what the market was pricing Tesla to do, I would tell you there's no way. But there's another way to look at this framework in terms of what the market's pricing for Tesla. And it's not return on assets, it's to think about it in terms of earnings. Now, if I look at Tesla in terms of market expectations for EPS, uniform EPS when we clean up the data, it still looks crazy. Right? Tesla is effectively a company that had sub $3 of EPS last year, and the market's pricing it to get to $30 of EPS. That is insanely high if we thought Tesla was going to continue to be what it has been so far, which is to be a car company. But the interesting thing about Tesla, and this is where things get really, really not as crazy in terms of these expectations. I'm not saying buy Tesla, by the way. But what gets interesting is if you take cars, which is where the company is now, to then you add on top of cars energy storage, right, which Tesla's partially in now. But if you talk about the market opportunity for energy storage, it is massive in terms of what the market opportunity is for, right, think a utility scale idea for power walls and everything like that. But then on top of that, you add autonomous transportation, and then on top of that you add robotics, and you combine all of that, Then if you actually look, and we did a really interesting report on this for what it's worth, because we actually do think that there's something really big happening for Tesla that is coming for Tesla, which is why Elon is talking about a $30 trillion opportunity for Tesla and everything else. And we actually broke apart why that $30 of earnings number might not be crazy for Tesla because of these 4 big drivers. And we talk in detail about how those 4 drivers could or could not get to that $30 stock price. And it's all part of this big special report that we actually just did around what's going on for Tesla and what's going on for a market that Tesla is about to be the center of, just like it was for EVs. And if you want to hear about that, by the way, there's a link on the bottom of of the video. That's teslanextmove.com. That's teslanextmove.com. Take a look, click on that link, and you're going to be able to understand what the big opportunity that we think is for Tesla and why we think in a special report that if you actually watch the whole entire video and take the jump of what we're offering, you'll see why we think maybe Tesla is fairly valued, or whether or not we think Tesla can get even higher earnings than that, or whether we think that Tesla's earnings could fall below that. And so that's our 3-minute drill on Tesla. And that's why we think that things are so exciting for Intel also. That's this episode of Altimetry Authority. If you want to see another 3-minute drill just like this, or want us to cover a different company, again, drop that into the comments below and hit the like and subscribe button, and we'll be back next time. Thanks so much, everybody.